All right. Today on the show, we have David Frasz. So basically, David does all my financing. He's one of my advisors for anything that has to do with getting a loan in multifamilies. David practically is my consultant. Whenever I look at a deal, before I look at it, I always pick up my phone, call David, run it by him. Kind of gives me a game plan and a strategy, typically before we go hard on a deposit. So, David, welcome to the show.
Yeah, thanks for having me. Glad to show up and talk to you for a couple of hours, I'm sure. But it's always great to touch base with you. We're on the phone regularly, so it's
Yeah, so David, I know this is going to be I know I'm going to enjoy this podcast because I know the value that you brought to our industry and to my business, and I say that with all sincerity. There's a lot of things that you saved us from mistakes that we could have made, and that comes from your experience and in your background in underwriting. So first, I would just want to jump right into it and kind of tell the listeners how you got into real estate and specifically how you got into financing in commercial loans like multifamilies.
Sure. Yeah. For me, getting into real estate for me was sort of like a lucky accident. I don't know if you've ever noticed, but the harder you work, the more you grind, the luckier you get. And for me, I got to a point, I had been working in banking at a couple of large banks for a number of years and really hated what I was doing. And I wasn't growing, didn't have any direction to kind of throw my energy, my passion into. And so I realized I had to make some change. And I started networking really aggressively, like 3-4 a.m. emails aggressively. And pretty soon, I had interviews with some pretty big time investment consulting companies. And one of them gave me a case study to do, kind of homework for the interview. And it was to choose from a list of investment companies and compare two of them and come up with a recommendation for an investing client. And I ended up selecting two real estate companies. And the more I learned about their business and what they do, I didn't want to be in investment consulting anymore. I wanted to get into real estate. So from that point, all my networking shifted into real estate. Pretty quickly, I found an opportunity to begin screening debt for my first company in the business. And I ultimately wanted to be on the buy side, but I was learning really valuable skills on the debt side, developing a good skill set, and ultimately I was able to kind of marry my passion, my skill set that I developed in underwriting with my passion for working with clients and building relationships. And so kind of, I guess, full circle, the way I would describe what I do now is basically investment consulting, as you know. So it's kind of full circle, but that's kind of my story about how I got to what I'm doing now in real estate.
Yeah, I remember when we first met. It was actually my first Fannie Mae deal with Louis Berker, which I interviewed in an earlier podcast, and we talked about that was me and Louis's first Fannie Mae deal. And I remember I had done a lot of loans in the past, but it shocked me because I was surprised when your email came out that you were going to fly in to walk the property, and I just panicked. I'm like, what? The underwriter's flying to the property to walk it? Like, I had never seen that because I come from a residential background. So no one ever does that. You know, you have an appraisal and that's it. So immediately I call Louis. I'm like, dude, the bank is sending the underwriter. Is this normal? And you came over, you walked the property, you saw a few units. And I remember the experience was after meeting you was calming. Like, you just, you had your questions, you had your concerns, you did your inspections, but you also gave me great advice throughout that process. And that's when the relationship started. I'm like, dude, I like this guy. You're very genuine about that. and you actually cared. You didn't run through it. I'd done appraisals. I have a background in appraisals, and I seen what some of the appraisals are just, they run through properties. They don't really care about what the owner's going through the process. I probably had a poker face, but I was freaking out. I'm like, this guy's basically could kill our deal right now. So that ended up being well, and ended up being a great deal of execution. We closed the loan. We ended up assigning that mortgage a year later. But that's how this relationship happened. So David, I, I want to go more into your how you decided to get into specifically multifamily. So I know you're covering that side, but I mean, what drew you to specifically multifamilies?
Yeah, that again was just kind of a sort of an accident. I my first job was in real estate, was with this company, and I was actually underwriting all sorts of debt, but mostly multifamily. But there were retail centers and office buildings and that sort of thing. But one of the primary differences with multifamily versus office or anything else is it's really easy for anyone, you, me, anybody else, to understand multifamily. You can understand an office building because you've worked in an office, or storage because you've had to put your stuff in storage. But multifamily on a different level, where we've all lived in an apartment and had, the water heater go, or had, a landlord, raise the rent, or, had tenants next door that were doing things we didn't like. So it's just from all those respects, it made multifamily really easy to understand. And again, like I mentioned, the harder you work, the luckier you get. And I just found my stride in multifamily, and really just allowed me to progress very quickly in my career early on. And it was just kind of history after that. So, I'm always happy to talk through other commercial deal, but multifamily for me is kind of where it's at. It's just what I'm best at in the business.
So let's jump into the tough question, because I know that recently we closed two loans during COVID, and there's certain conditions and certain things that changed. That I mean, you warned us about it, but it still hurt. Is financing during COVID? What is the new norm, and what is it that investors should expect?
Yeah, it's a good question. I think ultimately the new norm is COVID, at least for the time being. But ultimately, the things that really that an investor needs to think about and understand when it comes to working with a lender, especially during COVID. But right now, everyone is a little bit more skittish about the underwriting, the collections, the rents, market problems, whether people are paid up, whatever it is. Really doesn't take much to spook the credit team. And so you just have to kind of understand that your lender is going to ask you for, an updated rent roll every week, whereas you used to maybe get away with a rent roll for 6 weeks before your lender would ask for another one. But now we're going to want those more regularly, so we keep tabs on how things are moving at the property. Same thing with collections. We're going to want collections every couple of weeks instead of every 4 to 6 weeks or something like that. So there's certainly a lot more scrutiny. And then, I know this is kind of where it hurt a little bit, but the debt service reserve is, not all lenders are requiring that, in the sense that, banks don't necessarily need to do that if they're holding it on their balance sheet, but they may come in at a lower loan to value to compensate for the risk of not having a debt service reserve. So there are a number of different ways that any lender can mitigate, the risk of the COVID economy. But the way we've done it, the way Fannie and Freddie have done it, are to require a debt service reserve. And so that's kind of the big, change that really hits you, because, your 80% LTV may turn into, 25% down, because, the couple $100,000 might be going into a debt service reserve, which is still your money. You'll still get it back. But, it's being held back at closing. So that certainly hurts.
Yeah. So what advice would you give to an investor that is looking to get into financing his first deal in Fannie or Freddie? What would be the first things that you would suggest them to do?
Yeah, I mean, I think one thing is complete transparency, because there are a lot of situations in lending in general, but particularly with Fannie and Freddie, where investors don't necessarily think it's an issue, but it could really change the loan program, the terms, or even their ability to get the financing to begin with.
Give me an example of that.
For example, someone who lives in California wants to buy a property in Florida, and they want to self-manage it. Maybe a 10-unit property. They may have had, rentals in the past, and they've self-managed. They don't think that there's too much trouble collecting rent or, serving notices or whatever. But at the end of the day, when it comes to a non-recourse Fannie Mae and Freddie Mac loan, they want to make sure that asset is not going to go belly up. And so they want maybe someone who's closer to the property. Maybe they want a third-party management company. Maybe they want, if they're going to allow you to self-manage, maybe they want to see that you've owned and managed multifamilies, for the past several years, and you've been successful with it. So there are a number of things like that. So, working through a whole, book on, sizing up a loan doesn't necessarily matter if I then find out later on that the investor doesn't want to have a management company, and Fannie or Freddie just won't go for it.
Yeah. So let's say my property's a couple hours drive away. What's like the limit that Fannie will say, okay, yeah, you're a little bit too far from the property? And I say this because I buy throughout Florida, and I know we've had this conversation before, because we do self-manage down here in South Florida. So what's an example of a distance that it's time for you to get a property manager?
Yeah, I mean, there's not really any firm, distance that I can say. I mean, certainly you could be, an hour drive in Florida, but it might only be 30 miles, So generally the way Fannie and Freddie consider local to the property is within 100 miles. And that's kind of the cutoff where then you start being considered non-local if you're outside of that. But being non-local doesn't mean that you can't get financing or that you're required to have a third-party management company. It just means there are additional check boxes that need to be checked. So if you don't live local, if you've never owned a multifamily before, and you're buying a 60-unit building across the country, you're probably going to be required to have a third-party management company. But if you've got 2,000 doors and you've been in multifamily for 10 years and you've proven that you can self-manage and you have other assets in the market, you probably get away with not having a third-party management company.
So do you finance nationwide?
Yeah.
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 Okay.
Yeah.
Puerto Rico? Are you doing Puerto Rico also?
We can do Puerto Rico. Yeah.
All right,
yeah. So, I mean, I've over my time, I've done deals in probably the majority of the states across the country. I haven't really thought of any that I haven't. I don't know that I've ever looked at a deal in Alaska, but I've certainly seen business in Hawaii and Puerto Rico and everywhere else.
All right. So this is a question that I actually would have loved to know this early in my career. So when you do the transition from residential to commercial, uh, in the residential market, you go get pre-approved first, and then you go and look for your house. Uh, Commercial's a little different because it's a business, it's asset based, the income of the business, it's kind of what's evaluated. So I'm on the market, I'm looking for a property for a multifamily. When do I reach out to you? Do I reach out to you when I started looking? Do I reach out to you while I'm underwriting? Do I reach out to you when I made an offer, or do I reach out to you when I have an executed contract? Like when would you want someone to start talking to you?
Yeah, well, I mean, my answer to you is going to be different than my answer to someone else on that, but I always say it comes down to when you as the investor feel like you need to dial in your debt. So someone like you that's been doing this for years and we've gone through many deals together, you kind of know how we underwrite, you know what the requirements are. You're going to be able to even probably ink the PSA without me looking at your deal, and you're going to know whether it's clean or not. I mean, maybe if it's a hairy deal, you'll come to me and we'll talk through it and we'll work through it ahead of time.
Which I did this weekend. I contacted you on a short-term rental portfolio,
Yeah.
and I needed your advice on that.
Yeah. So more complicated deals, but that's the point, right? I mean, you knew that was the kind of deal that you needed to talk to me first. For a newer investor, that they may hit that point is they're underwriting a deal and they may not know how to underwrite their taxes, or they may not know what makes sense for a management fee in that market or something like that. So obviously for those folks, I'm a resource for them to reach out to, along with reaching out to their mentors and, listening to podcasts like this and reading books and things like that. So I'm just another resource, but as they get more experience, they know a lot of those answers, and we work through things. So when they get to your level, they know if something's clean or if something's not clean. And so I always just say, if you get to a point in a deal where you feel like you really need to pencil in on your debt, for example, you put your first offer in, you feel good about it, and then you find out that the other offers that came in on the deal are $1 million higher than you've offered, and you want to see if you can get there, but you can't do it without really knowing what your debt's going to be. So that would be a point that you'd reach out and we'd work through it.
And we're seeing a lot of that. We're seeing, I see it all the time where my offers just sometimes they just get blown out the water. And, there's just different types of debt that, these buyers are securing or they think they're going to secure. So a lot of them go in, especially with the low rates that we're seeing. So it's pushing prices up. So it's becoming very competitive in itself. So, David, tell me about a deal that that was very challenging for you, and this way people could understand if they see anything like that, they could kind of get ready for it. And how'd you overcome that deal?
Yeah, I mean, it's
I know they're all challenging.
They're all have their own challenges. I love the ones that are very smooth and easy to manage and kind of quarterback through. But a lot of times that's not life, and that's not real estate. I mean, real estate in many ways is life. So, we're talking about housing. It's life. So, I mean, what I would say there's a few things, and then I'll kind of talk about one deal in particular. But in insurance lately, over the last 18 months, 24 months, has been something that's been challenging on every deal. And the insurance carriers are not, they're not dropping their rates, that's for sure. And they've seen a lot of claims over the past few years. There are a lot of things that they want covered, and Fannie and Freddie require a solid insurance policy. So I have seen that become an issue, and sometimes you need to switch insurance agents. Sometimes you need to think creatively. I mean, for example, I had a property where we were just a hair of the property was in a flood zone. And what we had to do is we had to break the insurable value down by story, because the first story of the property was just concrete parking with pillars going up to the units on the second story. So we were able to sort of bring our insurance down on that to make it so the underwriting still made sense for the deal. There are complexities with homeowners associations and fractured condominiums. There are, like you pointed out, there are hurdles with short-term rentals, and whether they're advertised on Airbnb or if they're short-term rentals that have an on-site property manager who's leasing out for 2 weeks or 4 weeks or whatever. The one in particular that comes to mind is a challenge is the deal that you and I are working on right now. Collateral that is not true multifamily, commercial multifamily collateral with units that buildings that are 5 or more units, which is generally kind of where residential and commercial meet, is that 5 unit mark. And so with this particular deal, you bought a property. I mean, I'll let you tell the story, I guess.
So I'll jump in we bought a 18 unit portfolio with single family and duplex, triplex, and fourplexes. It was a total of 41 units in total. We got a great deal in Jacksonville on this property. It's typically not the type of deals that we buy. We like to buy multifamilies, all 41 units all under one roof. That would be ideal. But it was such a home run that we had to buy it. When I bought the deal, I wasn't too sure if I was going to be able to put this in front of you. And we ran through it a couple of times, and, you were trying to figure out solution. And one of the solution was that we found was get the single families out, get the smaller fourplexes and triplex duplexes, bundle them up. But we had an issue. We had some vacant lots in between. They weren't all connecting, but they were in a surrounding neighborhood. They also have been managed all together for years. So the portfolio has its own name, its own brand. It's always been ran this way. So if you were to search the property, it was run together. So that helped us out in the structuring, and you just pulled it off. So we're
yeah. I mean, it wasn't that easy.
No, it wasn't.
But yeah. I mean, ultimately, for everyone listening, we're talking about, if you draw an I, a capital I, that's kind of where the property was. It was all along one street and 2 perpendicular streets. And each lot, each kind of tax lot had anywhere from 1 to 4 units on it. So the challenge was really with Fannie and Freddie. They view that as those are single family, those are residential lots, not commercial, not multifamily. And so we had to find a way to include as many of the units as we could to keep the integrity of the property. So you can manage it as one property instead of having to find different lenders for different buildings, instead of having to sell the majority of the buildings, things like that. And ultimately, it came down in this particular situation that we had to exclude any parcel that only had 1 unit on it. And not only did we have to do that, but we had to find a way to make any cluster of units total to more than 5. And then we were able to link each cluster of 5 or more to another cluster of 5 or more. And so that's how we were able to ultimately get sign off for it. But these were conversations that went right up to the highest levels of Fannie and Freddie. And it's that sort of thing where this is the kind of deal that if you knew those rules, you knew those guidelines, you might look at the deal and say, this can't be done. But with your patience, I was able to get
we figured it out
to figure that one out for you.
Yeah. So what is the difference between a lender and a broker, and which one are you?
Yeah. So I'm a lender, and I think that's a really good question, because there are a lot of brokers out there that they say, yeah, I'm the lender, or I'm a lender, or I lend all over the country, or however they word it. A lot of brokers do kind of pitch themselves as lenders because they are underwriting financing, and they are working on the loan process. But the real difference between a broker and a lender is that brokers find you your lender, and the lenders actually give you the money. So we underwrite the transaction. We make sure it fits within our box. We go to credit committee. We issue approval. We write the loan. You get the loan documents. They have our letterhead, our name. They have our executives signing the loan documents. That's the difference between a broker and a lender. So the kind of the pros and cons, or really just the pros of each, is that brokers are great. They're best at finding lenders, particularly for transactions that have some sort of complexity that makes the deal tough to stomach for some lenders. So there are certainly deals that we can't finance. For example, if we hadn't been able to pull off that kind of packaging that we just talked about, you would need to find another lender, or you'd have to exit the property. But either way, someone's going to have to find a lender for that deal. And so that's where brokers come in, because they have a Rolodex of many lenders that do many different things. Some lenders like big properties. Some lenders like little properties. Some lenders don't mind packaging deals that are 10 miles apart. Others want them to be connected or attached, contiguous one to the other. So that's where brokers really shine, is when it comes to finding a lender to finance a deal that's outside the box for other lenders.
Which is true. That's when I use my brokers, when I know something that I have no business calling you for.
Yeah, exactly. So, for example, if you wanted to pick up a mixed use deal that was maybe, 50,000 square feet, and 30,000 square feet was retail, and 20,000 square feet was apartments. That's a deal that I wouldn't be able to finance, because it's mostly retail. And so in that case, you'd be best off working with a broker. Alternatively, lenders, as a companies like my company, Lument, we have originators like me who are kind of in-house loan originators, and our role is to nurture the relationship with the client, understand what they're trying to achieve, what they're looking for, what their business plan is, and then navigate the loan process and structure a loan that gets them to the best result.
And that's, I'm glad you mentioned the word nurture, because that's one of the things that has happened between us throughout the years. And I'm going to give an example, which is, it's an incredible example of how we have nurtured our relationship, and about a recent deal that I closed in Ohio with a group of guys that came out of a conversation with you, with Gwaith and Doran and Mike and Chris and that group. We bought this property in Ohio for $8.2 million, and I met them with you through a conversation on Zoom video. They partnered up with us in the deal 50%. So that was a referral. You basically put us together with a group of guys that you've done a lot of financing for. You felt comfortable that you could introduce us and that we would work well together, which that's also a risk that you took, because it could have gone sour. So you introduced us and ended up putting together an $8 million deal, which now you're going to refinance and get us out of our bridge debt. So it was a win-win. So nurturing relationships is very important in this business. I to this day, I'm grateful for that.
Yeah.
What
I
you
mean,
told me.
for me, that's why I'm in the business, honestly. I mean, that's where I get the satisfaction and fulfillment from what I do. That gets me, waking up and kind of just grinding all day. It's the relationships for me. And, when I have a great client that wants to do more business, but is constrained by one limitation, and I have another client that's constrained by a different limitation, you guys pulled together and really meshed after the kind of the first conversation. You guys meshed together really well, and there happened to be a live opportunity that you guys could discuss. And I think all of you were just super transparent with each other about what was going to work for you in a partnership and what wouldn't work. And you guys were able to make it so all the things that would work came together. And so yeah, that's exactly it. I mean, a broker, could do that too. But at the end of the day, they are mostly focused on kind of a transaction, in the sense that they're not necessarily underwriting the loan. They're not closing it and taking the risk on it. And so it gives me an opportunity as a lender to really invest a little bit more on those relationships. Not that brokers don't invest in their relationships, but I think for me that's the biggest part of what I do.
Yeah, I think there's a value to that. So by you connecting us to another group, you gave us more financial power to buy a property. You networked a group that now had a certain amount of money. Now you combine this. Now we're able to buy a bigger property. So it's all like a marriage. Like you benefited us. Now you benefit because now you're doing the refinance. So it works. I think brokers should be doing more of that. So, it's kind of if they see that there's a group, because at the end of the day, you see how the groups work, and you get to see underwrite their deals. So you guys, you know what? These two groups work very similar. They're buying the same asset. They kind of have the same strategy. Maybe they should meet, or just out of just a regular conversation. Look what came out of it. So that was actually a good strategy. I don't know if you strategized it on purpose, but it worked. So we'll just
No,
leave it
I
at
mean,
that. We'll leave
it
it at
really just comes, like I said, I mean, it
yeah.
comes from understanding what your client is looking for. And one of the things, when I talked to those guys, what they were looking for is they were looking for more deals.
Yeah.
And what you were looking for is sort of more ability to close more deals. You had plenty of deals, but you were stretched a little thin, and you needed to kind of partner up. And this gave you an opportunity to attack a deal that was further outside your market without knowing that, you're going to have to fly to Ohio every 3 days to keep tabs on things, so you spread it out. So just understanding what people need, and how to help them achieve it, because
it worked.
It's a long-term game.
Yeah. All right. So tell us what is important to know about debt service coverage ratio and LTV, loan to value. Just summarize that for us really quick.
Yeah. So the debt service coverage ratio is basically your net operating income, or your net cash flow. And the calculation is you put that over your mortgage payments. So your debt service, your principal and interest, not including taxes and insurance, but your principal and interest might be $100,000. If your net operating income is $125,000, that would be a debt service coverage ratio of 1.25. And the loan to value is just it's really just a ratio. It's a maximum, the way we use it as lenders. So for example, I had a situation where we were sizing based on the debt service coverage. We were sizing to 78% loan to purchase price. And the investor said, well, can we just, do 80? It's a cleaner number. And the answer is no, you can't. 80% loan to value is just the maximum, kind of that, the bank or Fannie Mae or Freddie Mac or whoever will lend based on the purchase price or the value of the property. But the real sizing constraint is kind of, does it meet the requisite debt service coverage ratio? So that's the primary constraint, and it's kind of basically, essentially, that's the minimum NOI or the minimum cash flow that a property needs to achieve in order to meet the lender's requirement for servicing the debt. And so you have to underwrite a deal properly in order to get your proper NOI. And keep in mind that the lender oftentimes is going to underwrite a deal differently than you might as an investor. And simple example of that is, if you self-manage a deal, you're buying a property, you're going to self-manage. You say, oh, I'm not going to have any administrative costs because I'm just going to write my own leases and I'm going to print them off in my inkjet in my office, and that's going to be that. So you may budget, $5 a unit for administrative expenses, but in reality, your lender, if they take over the property, they're not going to be able to operate your property with $5 a unit in administrative expenses. So they're going to have to budget something higher. So, sometimes there's a difference between your debt service coverage and mine.
Yeah, I see that all the time. And I actually used to make that mistake too in the beginning, where I used to underwrite. I wouldn't put any administrative fee. I wouldn't put legal fees. I wouldn't put reserves. And you quickly learn that. And when you start doing your first deals, that, oh, I need to budget for that. Oh, I need to account for that. And actually, I would say sometimes when you put your first deal through a lender, it opens up your eyes. They kind of like for they kind of save some deals from owners hanging themselves, because they kind of like, dude, you need to put this in there. I know you think you're going to save it, but you're probably not. So you guys are like a screen that sometimes people need, because they're just naive of what the reality is. So sometimes we have to underwrite and put all those things in there. Even if we think that we're going to save it, just put it in there. You never know. So that's interesting that,
another really common example, just jumping back to the kind of the insurance point I made earlier, is, if you're buying a deal for $1 million and you're going in with all this energy and this, you're well capitalized and you're gonna, put a bunch of money into it, and you're gonna increase the value to $2 million, you're not gonna get an insurance policy that, you're not gonna only insure $1 million worth of property. So, you might underwrite, oh, well, if the seller can get a policy at, $4,000, I can get a policy at $4,000.
Oh, I see that all the time. I see it.
Yeah, you double your value or whatever, and the seller may be underinsured. So if you want an actual, policy that really covers you, you might need to triple up on your insurance expense, and that's
and you see a lot of that, because the seller's underinsured because some of them don't have any debt, or they have a friends and family private lender. So you're underwriting a deal based on their insurance, and then you get a reality check, especially if you're in a flood zone. We see that all the time here in Florida. Our insurance policies are pretty high over here. So I get schooled on that all the time. So I know to get in my insurance during the inspection period. You do not wait for the last minute on that, because that would really throw your numbers out of whack. Our Fannie Mae and Freddie Mac loan securitized, and what is important about that for the listeners? What is it that they need to know about that so they can understand that?
Yeah, they are securitized. So that's the difference between a credit union or a local bank or any other balance sheet lender. Most bridge lenders are balance sheet lenders. Your hard money lenders are essentially balance sheet lenders. So they do a loan, and then it just sits there on their books, as an asset. so the difference between securitizing a loan and letting it sit on your books is that the loan becomes a security, becomes an investment that Goldman Sachs, Bank of America, Fannie Mae will, buy their own underwritten securities. So the reality is we package up our loans and sell off the rights to that income stream, the interest, right? What's important to understand is we do continue to service the loan. So if you do a loan with us, as opposed to in the residential space, those loans get securitized as well. But you might do a loan with, I don't know, Infinity Lending in your hometown or something like that. And then as soon as they close the loan, 15 days later, you get a letter in the mail saying, Bank of America bought your loan. And so now you have to send Bank of America a whole bunch of pieces of information that you just went through the loan process. You thought you were all done. For us, we'll close your loan and you won't ever get transferred to Bank of America. They may buy the security, they may buy the interest that you're paying, but we still act as the servicer and the asset manager. If you have an issue with your loan, you would talk to us. I would remain a point of contact for you throughout, the life of the loan, whether that's 5, 7, 10, 30 years, whatever it is. And so that's really important to understand when we talk. If someone, one of your listeners says, "Oh, but the loan gets sold," no, it doesn't get sold like it does in the residential space. We still service the client. The other thing to know on that is, I had when rates really started tanking earlier in 2020, had people thinking, "Oh, rates are near zero. Can I get an interest rate near zero?" And it doesn't work like that. Because again, nobody who is going to lend, whether it's a hard money lender or a bank, nobody's going to lend at no interest. It's just the cost of capital. They could do too many other things to earn a return on that capital. So rates don't, if the Fed takes rates to zero, your interest rate doesn't go to zero. It goes lower, but it doesn't go to zero.
Got it. All right. So how do we look at net rental income versus other incomes? So just for the listeners to understand what an NRI is,
Yeah.
give them some clarity on that.
Yeah, that's a great question. It's an important one too, because a lot of times we'll get, not just we, but you. You'll be talking with a seller and you'll get a simple statement that says, 2019 income of 100,000 or 2020 income of 80,000 or whatever. But oftentimes with multifamily, these are businesses, right? And a bodega on the corner doesn't just sell Coke. They sell Coke and gum and everything else, right? And so they want to know, if they're selling lots of Coke, they don't want to just keep buying more gum. They want to buy more Coke. So it's one of those things where, as a lender, we need to understand, and you as an investor need to understand, how much of this income is coming from people paying their rent and how much of it is coming from other income sources, pet fees, late fees, water billing if you have a RUBS program, parking fees, attorney's fees, whatever, insurance proceeds. You might have someone report $100,000, have a seller report $100,000 in income from 2019, and then it goes to 80,000 in income in 2020, and you say, "What happened?" And they say, "Oh, well, we got 20,000 in insurance proceeds." Well, that's a big deal, because you're not going to want to account for 20,000 every year in insurance proceeds. Yeah. Additionally, if a property is performing poorly, there could be a lot of late fees. There could be reimbursement for attorney's fees. There could be plenty of things that you don't want to necessarily count on moving forward. If you install, new tenants that are paying on time, you're not going to have the late fees. If you take a property from 50% occupied to 100% occupied, you're not going to have, 10 application fees every month because you're already 100% occupied. So you do need to kind of parse that stuff out. And from the collection standpoint, the only way to tell really what the bad debt is at the property, what the collection loss is, how good the tenant base is at keeping their end of the bargain and paying rent, is to know exactly what is rental collection. So NRI is net rental income. Not net
you see that I see a lot of that on self-managed properties where it's just a mess. You don't know where anything is coming from. It's not identified. I mean, professionally managed properties, they will have the breakdown. But yeah, I know exactly what you're talking about. It's you become a detective. I go through that all the time, trying to figure out when you're trying to buy a deal, where did this come from, and it's all over the place. So presenting that to you is very important in the cleanest manner possible. And it's also good for you to understand that as an owner, as a buyer, when you're looking at that, and even as a seller, there's nothing worse than when you're selling a property and your buyer does not know what the income is and where is it coming from. It just raises red flags. It would definitely sweeten your deal if you're very transparent in the transaction and just allow people to understand what they are. If they're late fees, it's fine. We all understand. There's a lot of those right now during COVID. All right, let's jump into. Go ahead.
Oh, the last thing I was going to say on that is, it's not always perfect. Like, you don't always get that. But that's one of those things that is important as a buyer before you go to your lender and expect them to turn around a term sheet in 24 hours. You want to make sure that that's something you've already asked for.
Yeah.
If the seller can't provide it and they keep pushing back, that's one thing. But you don't make anyone's job or the timeline on your deal any easier by not asking that question. So it's the same thing with leases and other things, that you may have what you need. If you're buying a distressed property as an investor, you may have what you need to underwrite the deal. But you got to think about what your lender is going to need too. So even if you don't need it to make your green light decision to go forward with a deal, your lender is going to need some things that you want to make sure to ask for.
That's true. All right, so everyone knows the standard loans that are out there, the ones that the basic ones, but there's some really cool ones that when I was talking to you before this show that I was surprised to hear, and I thought I knew them all. So let's run through some of these, because there's one there in particular that I really like. So
which one do you like?
Let's start with I mean, I'm not a fan of the 30-year loan one, but I think there's a lot of folks out there. One, I've seen, I see that a lot in my business, where people have holding on to these properties for 20, 15, 30 years, but they don't know about this. So let's start with that 30-year program.
Yeah. So I think you're right. I think one of the reasons is people at different stages in someone's investing life, they kind of sort of think they've got it figured out, and then, like you, they realize they don't necessarily have everything. And so what happens is, with residential loans, often you're stuck at like what are you have a 10-year ARM or a 30-year fixed, or maybe a 15-year fixed, which also amortizes over 15 years. But then people start kind of getting into the multifamily, the commercial side, and they start working with banks. And a lot of banks will do like a 5-year deal with a 20-year amortization, or maybe they'll do a 7 or a 10-year deal, but there's still a balloon payment after 10 years. And if you're a buy and hold kind of family man investor, or a husband and wife that wants to own a property and then pass it on to their children and kind of build a legacy that way, you don't necessarily want a 5-year balloon or a 10-year balloon. And one of the things that we can do with Fannie Mae is we can offer many different loan terms, but we can offer a 30-year loan term, and that amortizes over 30. So that's just like your residential mortgage in the sense that after 30 years, you've paid off the mortgage and you own it free and clear. And so for you're not familiar with this because you don't.
No, that takes a lot of discipline. That takes a lot of discipline.
Yeah, right.
But I see it all the time. Like right now we're closing on an 84 unit. The owner has owned it for 25 years. And so yeah, you do see people that hold on to assets for a very long time, and
Yep.
They usually don't have too many partners. I'll tell you that. It's usually just one person, and so that's interesting to know that there is that you guys do offer that program. There's another program that I loved, it blew me away, was that you could get a second loan with Fannie on your property. So you could you don't have to technically need to refinance to pull your equity out if you already have a loan with Fannie. Correct me if I'm wrong.
Right.
So instead of refinancing, you just tag on a second loan and pull your equity or on the property. Can you explain a little bit about that?
Yeah, we call that's a supplemental mortgage. So what happens is when it's originated, you and I do a deal, and then 2 years later, you want to put on a second loan, or you want to refi, or you want to get some equity out because you've added a bunch of value. So we can do a supplemental, and if you have, let's say you have 8 years left on your loan term, we did a 10-year loan the first time around. We do the supplemental for 8 years, so they both mature at the same time. We call that coterminous maturity, and so now you can add another $1 million or $2 million onto your unpaid balance. So you get that equity. Maybe you invested heavily with capital improvements and you want to get that money back. So we can do that. And the only thing to note is that that second loan does not go through at the rate at which the first loan went through. So if rates go down, you would get the market rate at the time. So it could be good in that scenario. If rates go up, your second lien would have the higher market rate at the time that it's originated. But oftentimes that recipe, that strategy can be a good one when the majority of your debt from your first lien is originated at a time like this when rates are super low.
I'll tell you what another great strategy that's for. Let's say you want to exit the property and you know you're going to exit in the next year. You do the supplemental loan, you pull your capital gains out, you sell your property. Now you don't have to pay taxes on that property on those gains because you refinanced or you did the loan. So there's a lot of ways that could benefit you, especially on your exit too, if you strategize it correctly. That way you don't have to do a 1031 exchange. So that's another strategy. I agree, man. That's a great program. Let's jump into the next one, which is very interesting, the hybrid small balance loans.
Yeah. The hybrid loan is another interesting one, and that one is really useful for folks that are not so keen on having a balloon payment at a time when they may not know where the market's going to be. So for example, today you may want to do a 5-year loan because you don't want to lock in a prepayment for 10 years or something like that. And you may want to have the flexibility to sell or refinance after 5 years, but you might also not want to put yourself in a position where 5 years from now, the economy is really struggling and the debt markets are all closed off, and the valuation of your property doesn't support, the debt that you want, but maybe things are improving. And so if you hang on for a couple more years, you might be able to get the exit that you wanted. A hybrid loan with the Freddie Mac small balance program is a 20-year note. It's a 20-year note amortized on 30 years. So there would still be a balloon after 20 years, but you could do a fixed rate period of 5, 7, or 10 years. So for example, the 7-year fixed rate would then have an adjustable rate for 13 years thereafter. So you get to your 7th year, Your rate might adjust. It could be fairly similar if rates haven't moved from the time the loan was originated. Could be higher if rates have gone up. But you don't have to repay that loan at that time. You don't have a balloon that you have to chase around a lender and find someone who will finance your deal at that time. You can, even if you're having, one of your kids is graduating from college, and so it's a bad year to be spending, 2-3 months on refinance. You just push it down the road.
Yeah. Now, the last one that I want to touch base on is your program, how you could finance and build in your CapEx into the financing all the way up to 80%. That's pretty sweet.
Yeah. I mean, that's, you and I have done that. I think that's one of the lesser known commercial abilities that people don't necessarily know that we can do that. I actually had a conversation with an investor this past year. Sometimes you just don't know what you don't know, I guess. But I was pitching that opportunity based on what he told me his business plan was. And he said, no, Fannie Mae, you can't build in capital improvements with Fannie Mae. And he wouldn't listen. He was absolutely certain that I was wrong. And which is interesting given my background. But so what happens is we get an appraisal that factors in your capital improvement budget. And we can only factor in up to $8,000 a unit in capital improvements before it becomes a different loan program. And it kind of changes things. We can still do that, but it changes things and adds a little bit more complexity to the deal. But up to $8,000, we give the appraiser your capital improvement budget, and they do an analysis and say, yeah, we agree that after doing these renovations, your value will be, $8 million instead of $7 million. And when they do that, then we have that value and we can lend on that value. And lending on that value means you get a higher loan, even though those dollars for the renovations have to be set aside in escrow, and you have to kind of do the work, get reimbursed, do the work, get reimbursed. But once you've done the work, you end up with a higher loan balance than you would have otherwise. So therefore, you don't have as much of a need to refinance at that point because you've already got that higher level of debt. And therefore, from your perspective as a syndicator, you don't have to raise that extra $1 million in equity if you want to do, say, $2 million worth of work or something. You just kind of recycle the money that you're getting reimbursed from the lender.
No, this structure will skyrocket your IRR. It's an amazing. If you could pull it off and they meet all the criteria, I suggest you go hard on that one.
But that's the one caveat, is it still has to size.
Yeah, it has to size. Yeah,
the debt service coverage. So it doesn't necessarily work on deals where the rents are just way below market and the occupancy is terrible, and so you still have to have the cash flow to support the higher loan amount. But yeah, you're right. It can certainly turbocharge your IRR.
So I'll end the show with this one suggestion to the listeners and advice, and this is something I know you're going to want to jump in because it makes your job so much easier. And it's one that I know me and you have had that conversation, and I'm like, you know what, you're right. I should know that. One is sometimes you get into deals with partners, but you don't have a loan structure. You don't have sometimes you're just going so fast that one partner is saying, no, I want to do 5. The other wants to do 10 years. The other wants to do 7. It's really important that the partnerships, everyone's aligned with each other. And when they come to you, they tell you, David, our business model for this deal is 5 years or 10 years. This allows you to be able to consult them and structure them, say, okay, guys, this is what I have. This is the closest thing I have. This is what you should be getting. That coming to you and saying, I don't know what we want. It's like, no, you need to figure out your business model. You need to go back to your guys and talk to them. All right, guys, what are we doing here? And what suggestion do you have on that?
Yeah, that's a great question. I mean, again, it kind of goes back. I mean, most borrowers sort of end up letting themselves, not most borrowers, but a lot of kind of newer investors that are getting commercial financing kind of let themselves get pushed into um, the standard loan structure, maybe a 10-year fixed rate loan with 7 years of yield maintenance prepayment, without really contemplating how that jives with their business plan. And I've had conversations where I ask, I'm trying to figure out what loan term you want, what's your business plan? Tell me what you plan to do with your exit. How many years do you want to hold the property? Are you going to have investors? Is it just you? I mean, everything to do with the business plan helps. And I've had instances where the borrower said, I don't know, you tell me. Well, I can't tell you what your business plan is because I'm not the owner. So, but it's really important to talk to your lender about your business plan, because a 5-year deal with declining, step down 5, 4, 3, 2, 1 prepayment is going to put your exit in a very different position than a 10-year fixed rate loan with yield maintenance that could leave you paying 8% of the loan balance in 5 years if you wanted to sell it or something like that. So it's really important to get with your partners, like you said, understand the likelihood of a refinance after a few years, the likelihood of selling. And it's tough because you can't really have the best of every world. You may want all the flexibility, but you think you're going to hold the property for 20 years. And you sort of have to balance that out and say, what's the likelihood that I'm going to hold it?
Yeah, correct. Yeah. And what's the likelihood I want to have that relationship or that partnership? Sometimes that's a lot to consider also. And what stage you are that we talked about earlier in your life. David, man, this was awesome. There was a lot of information. Yeah, it was a refresh course for me. So I appreciate your time, man. How can the listeners get in contact with you?
Yeah. People can reach out to me anytime. Just use me as a resource if they want to get to know me. Certainly becoming comfortable with someone is the most important. So they can shoot me an email, david.frasz@lument.com. Maybe you can post that if you send this out, or they can give me a shout. 703-663-5886 is phone number. What I do, I'm on the phone all day anyway. So always happy to take an impromptu call with somebody who's looking to get in touch.
David, man, thank you for your time. This was awesome, man. We'll be in touch. All right, brother. Take care. Bye.